Okay, let's do another video update. It's July 24th, Thursday at about 11 p.m. The S&P 500 was down 2% today. It was its first 2% sell-off since February 21st, 2023. It was 357 trading days. So today was a pretty big deal in that respect, and we'll talk about equities in the latter half of the video. Let's start with the dollar. So last week, dollar relative sentiment turned bullish. We had been talking about that for several weeks in the newsletter because it was apparent that the smart money was buying the dollar on a relative basis to retail traders, and we sort of had a heads up that it was heading in a trajectory that could turn it bullish. Well, it finally turned bullish last week, and we noted that if and when it turned bullish, it could mean headwinds for equities. The equity market could struggle if dollar relative sentiment is bullish and the dollar is moving higher. So if you look over the past several months, the equity market first topped in mid-March, and the dollar was rising basically from the early part of March onward. And then the market bottomed in late April. That's when the dollar topped. And then the market started to rally again as the dollar sold off. And then the dollar bounced again. And the broad market sold off again, the Russell 2000, the equal-weighted S&P, most sectors, international stocks, etc. But mega cap tech kept rising throughout May and June, which dragged the S&P 500 higher. So it looked like the equity markets were rallying, but if you looked under the hood, most stocks were not rallying. And you know, we talked incessantly about the divergence in breadth, where you had more stocks making new lows while the S&P and the Nasdaq were making new high after new high after new high. So mega cap tech really masked the effect of the dollar rally from mid-May to late June. But since late June, the dollar's been selling off, and equities and the broader equity market has started to participate in the rally. But last week on Tuesday, the dollar bottomed. It started rallying from Thursday onward, and Tuesday from Wednesday onward, it started rallying, and the equity market has kind of been in trouble ever since. So this is something to take note of and to watch to see how this evolves. I wouldn't expect the dollar to go on a huge tear and rally a lot because you look, it's essentially moved sideways the last several months. And given the relationship between the dollar and the bond market and equities, and the fact we're so close to the election, I think the last thing the Fed and Treasury would want would be for excess equity volatility or bond market volatility this close to the election. So I would expect them to ease financial conditions, whether spending down the Treasury General account, shifting the issuance of treasuries to the near term, as opposed to selling on the long end, for the Fed to jawbone the market lower or to be dovish at the next press conference at the end of July. I would expect them to do whatever it takes to keep the dollar from rallying too strongly and for equities to suffer too badly. But nonetheless, dollar relative sentiment is bullish, and that tends to be bearish for gold. Here's a chart of gold, one-day chart of gold. I'm not sure if this three peaks in the domed house is really in play anymore, but it looks like gold peaked last week. Here it looks like it could be in a bear flag. This was taken right after the close today on the daily chart. The natural landing place for gold would probably be this trend line from the lows, which pretty soon will converge with the 200-day moving average, this red line. So this yellow circle somewhere around here, which is roughly around where gold broke out to new all-time highs in the 2200 area, that would make sense for gold to pull back to that level. Now if we zoom in, we see that gold has kind of broken down through that bear flag, what seemed to be a bear flag and what looks like it was a bear flag. As we look now, gold is at 2370, so it's down basically at the bottom of this candle right here. And we have a similar situation for silver. So initially I thought that potentially silver would bounce at this 29 level, make a lower high and form a descending triangle and then move lower, but it seems to be potentially in a bear flag itself. This was taken again after the close today. This is the 4-hour chart, and if we take another snapshot a few minutes ago, we see that silver has fallen, and this is at 2860. It's now at 2806, so it's fallen all the way down to 28 since I took this snapshot, call it a half hour ago. So it does seem like precious metals are moving lower. That makes sense given that composite gold relative sentiment is bearish. Typically composite gold relative sentiment is a composite indicator made up of gold relative sentiment, silver relative sentiment, dollar and euro relative sentiment. And when it's below 50%, that tends to be bad for gold. When it's above 50%, that tends to be good for gold. The combination of bullish dollar relative sentiment and bearish gold relative sentiment tends not to be good for gold, silver, gold miners, etc. But as you can see, the last few times that this indicator has been bearish, gold moved sideways here and it moved up here, and it again moved up here when it flipped bearish in mid-June. Now it's moving lower now, but it's held up relatively well the last 2-3 times that this indicator has been bearish, which is a testament to the fact that we're in a secular bear market driven by high inflation, one where we would expect gold to be one of, if not the best performing asset over the duration of that secular cycle. Central banks are buying gold, they're not buying US Treasuries. So the fact that composite relative sentiment in gold is bearish doesn't necessarily mean that it's going to tank. It could hold up relatively well, be resilient. But again, it's not an ideal time to buy gold. I wouldn't expect it to go on a huge tear from here with the positioning environment as it currently is. One last thing I'll say about gold before I move on to TLT is that gold relative sentiment is bearish, but institutions bought gold on a relative basis to retail traders pretty aggressively last week. And it moved the indicator to a level that if they continued to buy at that same rate this week, it's conceivable that gold relative sentiment could turn bullish either next week or the week after. That's if they continued that aggressive buying. If they didn't, then gold relative sentiment will still be bearish and nothing will have changed. But if they do flip gold relative sentiment bullish, that will be better than the current situation. But because dollar relative sentiment is bullish, that will provide still a little bit of a headwind for gold, and it wouldn't be the ideal situation. The best situation is when dollar relative sentiment is bearish and gold relative sentiment is bullish. We don't have that, and even if gold relative sentiment turns bullish, we likely won't have that because dollar relative sentiment will also be bullish, which tends to be bearish for gold. So keep that in mind. So here is TLT. The red line corresponds roughly to a 30-year yield of 4.45%, and we see that TLT can't really sustain above that line. It's tried many times in the last several months, and every time it gets above that level, it pulls back, which means that every time the 30-year yield gets below 4.45%, it bounces back above it, which makes sense because no term premium, given that inflation is going to be around for years, it doesn't make sense to accept only 4.45% on a 30-year bond. Now, if TLT falls and 30-year rates continue to rise, that also will likely be a headwind for equities. And if we look directly at the 30-year yield, we see that it's in a falling, broadening wedge. And most recently, we saw a similar pattern with the Russell 2000 before it massively broke out and went 12% higher. Now, will the 30-year yield do the same thing? I don't know. I know that given that we're so close to the election, if that yield were to bounce to that level, bounce strongly out of this broadening wedge, that would probably be very bad for equities, very bad for the bond market, very bad for the powers that be that want things to be relatively smooth and calm and non-volatile as we move into the election period. So I would imagine the Fed and the Treasury would do all they could possibly do to ease financial conditions to cap the 30-year yield if it starts to behave badly. But this is something to be aware of. It is in the same pattern that the Russell 2000 recently broke out of. So again, rising interest rates could be headwinds for equities in the near term. And if we look at TLT composite relative sentiment, we see that it is bearish as well. This has been a very good predictor of the long bond, not only over the last 2 years, but over the last 30 years. And right now it's saying the environment for long duration bonds is bearish, and the interest rates have started to rise again. So we'll see if there's follow through with that. This is oil. So commodities relative sentiment is bearish. Oil's been moving lower despite the fact we've had 4 consecutive weeks where the inventory draw has been much bigger than expected. In some cases they were expecting a build, and yet there was a draw, and yet oil can't really seem to find any traction. Now, if you look over the last year and a half, it's been moving in this sideways in this trading range. We wouldn't expect that to change anytime soon, especially as we're getting nearer to the election. The Biden administration said they would sell oil from the SPR if needed to cap oil and gasoline prices. The last thing they want is gas and oil prices to rise strongly as we lead into the election. That would be very negative from their perspective and for the consumer in general. So I'm sure they'll try to keep a lid on oil. But also the fact that commodities relative sentiment is bearish, largely driven by the fact that dollar relative sentiment is bullish, is also a reason that oil might not find any traction in the near term. Now let's move to equities. So this is the Nasdaq 100. These lines here are Fibonacci retracement levels. This blue line is the 1.618 extension of the distance from the previous all-time high in November of 2021, which was I think 16,767, I believe, and it fell down to 10,484 or something along those lines in October of 2022. So that distance, somewhere around 6,000 points. You do all this, math here and arithmetic, and you get this 1.618 extension level, which was at sort of 2,600 or 20,800 in that ballpark. The Nasdaq came up and basically was it ran into a brick wall when it hit that level. It went a little bit above it, but immediately fell back below it. It tried to get back above it, it couldn't, and it's been falling ever since. So that is actually a level where you might say, well, has the Nasdaq topped? And it's plausible. So we don't think the broader market is topped, but the Nasdaq has been leading everything higher, that it could also plausibly lead everything into a top. So the Nasdaq could top before everything else. And given that it seems like the bloom has come off the rose a little bit with respect to the AI trade, today's move lower seemed to be because of Tesla earnings that weren't favorable, Google earnings that were received unfavorably. It could be the case that the Nasdaq 100 is topped, but the Russell 2000, the S&P 500, the equal-weighted S&P potentially haven't topped. But what's interesting is that it pulled back from the 1.618 extension, which is this blue line, down to the 1.382 extension, which is this red line. And if this is a daily chart, if we look at the minute chart, it literally bounced right on that line. It hit that line and it jumped right before the close, and it's still a little bit above that line as I'm speaking right now. So maybe we get a little bit of bounce in the short term, but then again, we are still sort of above this trend line. It might want to go down and hit that trend line before bouncing. We don't think that it's going to continue straight lower. We think there will be a bounce, and we think there'll be another attempt potentially to retrace some of the sell-off. But it is plausible that the Nasdaq 100 has topped, given how much it's rallied, given that the AI trade seems to be getting more scrutiny from investors, and it seems like investors have moved on to the rotation trade into the broader market, the Russell 2000, the equal-weighted S&P 500, etc. If we look at the ratio of the Nasdaq 100 to the Russell 2000, now this is quite interesting from my view. So coming into the year, as I've mentioned on several videos, as well as in the newsletter, I was expecting the Russell 2000 to outperform the Nasdaq 100 because the Nasdaq 100 was so crowded and it had such a big rally last year, and the Russell really didn't have nearly as big as a rally, and it wasn't a super crowded trade, so expected that this channel would contain the ratio, and since it was near the top of the channel, it would only make sense for it to start moving towards the bottom end of the channel. Again, given the tech was crowded, small caps were not, you're near the top of the channel, the ratio was moving higher, but momentum was moving lower, so you had this bearish divergence. It just seemed to make sense that the Russell 2000 would start outperforming, and this ratio of the Nasdaq to the Russell would start moving lower. For several months, it was in an equilibrium. It was basically going sideways from seemingly February to middle of May. And then it shot up. So this was basically NVDA had positive earnings and the AI trade took off, but the dollar was rising and everything else went lower. So AI rallied super strongly and everything else went down. The Russell 2000 went lower. So that combination of the numerator rising and the denominator falling made this ratio shoot up higher out of this channel. Then we had the CPI report, and then there was a rotation. And this has moved violently lower since. So we've heard it said in technical analysis terms that when you have a failed move, in this case a breakout that failed, it tends to go very quickly and very violently in the other direction. And as you can see, that's what we've seen. So this took several weeks to get to this point, and this is only 10 trading days. So it's 3 candles, it's a weekly chart, but this basically started on a Thursday, and this is as of Wednesday. So this was 2 Thursdays ago, and this is today as of Wednesday. So this is 10 trading days, which is basically 2 weeks. It's moved about 12%. That's enormous. Now we're back to this level that it traded at for several months. So given how violent this move was, and given we're back to the level where it was sort of in equilibrium, it wouldn't surprise me if now the Nasdaq starts to outperform again in the near term relative to the Russell, which has done exceptionally well. And then maybe we form a bear flag, and then maybe we start moving lower towards the bottom end of the channel. But it seems like in the near term, the Nasdaq potentially could bounce, and the Russell might have some more pullback because it's done so well. So that's something that we'll be watching rather closely. But we do think that the broader market still has more room to run, and we'll get to that in a second. We'll look at the Russell 2000 and explain why. So it was in this falling broadening wedge, and those tend to be bullish, and sure enough, it broke out strongly. And if you look, the day before the CPI report, it was up. Then it was up on the day of the CPI, and then the Friday, then the Monday, then the Tuesday. And in those 5 days, a Whaley breadth thrust was triggered in the broader equity market. A Whaley breadth thrust is when, over a 5-day period, the number of advancing stocks, so you add up the number of advancing stocks on each day, divide it by the total number of stocks. If that ratio is greater than 74%, you have a Whaley breadth thrust. It's only triggered, call it 15 to 20 times in the last 70 years. And each time it's triggered in the past, the equity market was higher 12 months forward. So if this triggered in the middle of July, we would expect the market to be higher as of next July, if history is a guide. Now, the average return over those 12 months has been 23%. There have been instances where it's been only up single digits, so maybe we don't get a 23% return in the broader market, but I would expect the broader market not to have topped and for there to be continued upside. So it looks like the Russell might be forming a pennant here. Those tend to be continuation patterns, which we would then expect it to break out and rally higher from there. I would expect that the Russell 2000 will hit a new all-time high before this equity market, before this bull market ends. And that would be at least another 10% rise in the Russell 2000. Now, as we said, it's plausible that the Russell could go and make a new high, and maybe the Nasdaq 100 doesn't make a new high because it's been leading everything and it's up, over 100% from its low in 2022, or it was its recent high. So maybe the Nasdaq 100 lags in the next leg up in the equity market, and we do think there will be one because of this Whaley breadth thrust and several other reasons, which we'll talk about in a second. But let's look at some of the components of the mega cap tech cohort. So here's Apple. Now Apple was like around 170 down here, and at this peak here it was at 237. So that was about a 40% return from this level right here, and it happened in the span of, call it 3 months. So 40% in 3 months for a $3 trillion equity is kind of ridiculous. So the fact that it's pulling back here isn't a surprise, but this target here, which is 251, it was only 6% away last week at its high. We can conceivably, still see it hitting that But even so, the Nasdaq 100 might lag the rest of the market if we do have another leg higher, even if Apple ends up hitting that target. Here we have Meta. So it's been in this enormous megaphone pattern the last 4 or 5 years, and it hit the megaphone in the early part of the year, fell back, hit it again, fell back on bad earnings. It was in the low 400s, but it went back up to call it 530, 540. So a good almost 30% rally in 3 months. When Apple did about 40% in 3 months. So the AI trade was kind of ridiculous in the May-June timeframe. But it hit the top of the megaphone again, and it fell back. It has earnings either next week or the week after. I don't think it's going to fall lower straight away. I think it's probably going to make another attempt to hit the top of the megaphone, perhaps even another one, before eventually it succumbs to gravity as the bull market tops and we enter into a multi-year bear market. So here's NVDA. So this really actually looks like it is playing out. The 3 peaks in a domed house. Here are the 3 peaks. Here's the left shoulder. Here's the head. It looks like it's forming a head, and it might eventually form this right shoulder. I'm somewhat surprised. I thought there would be a higher high, especially because it had that phantom tick at 195.95. It wouldn't surprise me if it eventually hits that level. Maybe it does hit that level. Maybe it plays out, and it goes lower and then rallies again strongly from there. I don't know, but this does look like it is playing out, somewhat surprisingly. But I wouldn't dismiss the possibility that this pattern could bust and it could move higher after its earnings in August. So that's something to keep an eye on as we move through the summer. Now, one bullish aspect of today was that even though the S&P was down 2%, you had 165 stocks closed higher, and that's the most that's ever advanced on a day when the S&P was down 2%. So 165 of the 500 S&P 500 stocks were up on a day that the S&P was down 2%. So that's the most in the last 10 years. What that tells us is that today's move was largely driven by mega cap tech, and almost solely driven by mega cap tech. If you look at the broader market, it was down, but it was only down about 1%. So that's a somewhat bullish aspect of today's action. Now, if we look at the S&P 500 itself, the equal weighted S&P was down only 1% today, whereas the S&P was down 2.3%. From our perspective, it was basically a mega cap tech hangover from the relentless rise of mega cap tech over the last year and a half. So from January of 2023 until July, the Nasdaq 100 was up 50%. From the end of October until the middle of March this year, it was up 30%. From April 19th until July 11th, the CPI, it was up 25%. So it's not going to keep rising at that level in perpetuity. So what we've seen the last couple of weeks is the mega cap tech pullback, and it was catalyzed by the CPI that came in cooler than expected, and it gave the Fed the green light to lower rates, not in July but in September, and it also gave investors the green light to buy the broader market, and they didn't need to hang out in the safety of mega cap tech, or the perceived safety of mega cap tech. They could broaden out their portfolio, and that's what's happened. We've seen a rotation. So I don't think today was necessarily anything where the sky's falling, the equity market rally's over. I think this was simply a recognition that the Nasdaq just couldn't keep rising at the pace that it was rising. It had to pull back to kind of reset sentiment, pull back to a trend line, to a moving average, etc. And again, the broader market, it was down, but it wasn't down anywhere near as much as the S&P or the Nasdaq. So the bull case for at least one last leg higher is that momentum's still positive. Equity relative sentiment is bullish. We recently had the Whaley breadth thrust, and if you look historically, of the 15 to 20 times that it's triggered, there were 3 times where the first week after it triggered, the market was down 3, 5, 6%, only to rally from there substantially. if you go back to January of 2023, we had a breadth thrust. It was I believe it was a Zweig breadth thrust and or a breakaway momentum breadth thrust. And the market pulled back into March with the Silicon Valley Bank collapse, as much as 8% from when the breadth thrust had triggered. So it's not unheard of for the equity market to pull back after a breadth thrust had triggered, but almost invariably that is a great buying opportunity. So the fact that the market's pulled back, this might end up being one of the last great buying opportunities of this bull market before we ultimately top. So we had the Whaley breadth thrust. We also have phantom ticks and gaps higher. Now we do have a lot of gaps lower, which will eventually get filled, but we're closer to the higher gaps. So it would seem to make sense that the market would go up, fill the higher gaps before going and filling the lower gaps. It doesn't have to work that way, but it seems like that's sort of the order in which it would naturally happen. The election is 3 months away. So again, from the perspective of the powers that be, one, if the equity market falls, that's probably negative for the Democrats. And you have Yellen, who's in the Democratic administration. She'll probably want to keep that from happening. And also, if they end up losing the election to Trump, if you want to regain power and you're a Democrat, you'd want to hand the baton to Trump with the equity market as high as possible so that his cost basis is as high as possible, so the equity market has nowhere to go but down. And that's pinned on him such that in the midterms in 2026 and the next presidential election in 2028, the Democrats can retake power. So it would seem that the incentives for the administration would be to pump this market as high as possible. One, to keep the electorate from being ticked off that their 401ks are going lower into the election. You want them to be happy about their 401ks going into the election. But also, if they end up losing, you want to hand off the equity market to Trump as high a level as possible. At least if I were a Democratic strategist, that's what I'd want. So with the election 3 months away, I would be surprised if the broader equity market is topped and we're just going to move lower from here. And then I also think that we've seen this rotation, and I do think that the Nasdaq is unlikely to lead this next and potentially last leg higher. The Nasdaq will probably bounce, but it might not make new highs. And if it does, it probably will only make marginal new highs. And even if it makes new highs, it would probably lag still the Russell 2000 and the equal weighted S&P. Now, another reason why I don't think we've quite topped yet is phantom ticks. So this is the Nasdaq 100, the QQQ ETF. These blue lines are phantom ticks. They come out in the pre-market. The market isn't trading at those levels, but there's a print at those levels, and I, religiously track those, and these ETFs seem to hit those levels all the time. So we have many phantom ticks lower, and we have them all the way back down near the October 2022 lows. So I fully believe that the Nasdaq will reverse all of its gain from the last couple of years, so will the S&P, and go potentially much lower. But we're much closer to these ones that are above right now. But you can see that there aren't any near the all-time high, which was up here. They're a little bit lower than the all-time high. So that's why I think that the Nasdaq could bounce, but maybe it doesn't make a higher high. Maybe it makes a lower high before we end up rolling over. So that's a reason why I think that we haven't seen the top for the broader market, and that at the very least the Nasdaq 100 will bounce. So that's all I have for today. If you have any comments or questions, leave them in the chat, and thanks for watching.